I am excited to have this next fireside chat with Ilan Goudsmit. We're going to talk, as I said, about challenging times during this challenging times and navigating that as you're fundraising. So Ilan is a venture and growth capital specialist for the past 10 years, helping founder teams to scale up their tech businesses internationally. Amongst other things, you're a partner at Endite Capital, and you're going to be visiting the United States. You're having more and more contact with them, so really excited for you to share your insights on what you're observing there in the States and how it compares here. But welcome.
Well, thank you. Well, hello everybody, excited to be here. And by being almost like one of the final speakers, I hope everybody's still a bit sharp after so many conversations.
Yes.
And I don't want to have it all like talking about doom, but I think there's a big elephant in the room right now, being the challenging funding landscape ahead. So it was great times over the last years. Valuations were high, like 40, 50 times ARR. A lot of funds raised money, but I think the dynamics, unfortunately, are changing. And I think maybe it's a bit of a healthy dynamic in terms of valuations, but there will be definitely challenging times ahead. So what's happening, like the public markets, for especially tech stocks, went down like 50 to 80% depending what vertical. And all investors need to make money, like the IPO investors, the pre-IPO, and the rounds before us. So we invested as Endite in late A, B, and C rounds. So we also like to make money. And there we're seeing already that the lower valuations are trickling down to us. So where we also see that valuations are becoming lower. And this is just, I think, a new reality that we all have to accept, especially founders. And it will take some time, but we're actually seeing it right now happening. And so I think there will be a few dynamics what will happen with the challenging time. Rounds will take, unfortunately, a bit longer to close. So start preparing and start raising your round sooner than later, because maybe on average it took for hot startups a few months or a few weeks even. Now it's taking longer. And if you're, let's say, a company that has less good unit economics, so not an amazing net dollar retention or not an amazing CLTV CAC, I think those companies especially will have a harder time raising money at the valuation they thought maybe in October last year they would raise it. So we see nowadays in companies we are trying to invest in that sometimes the rounds are being closed at the previous valuation of the previous round of a year ago. And those companies grew perhaps 100%. So that's like a new reality we're living in, unfortunately, for the startups. So what we also see that rounds are becoming probably less large than they envisioned. Also not to dilute too much. So I think these are a few of the trends we're now observing actually in Europe and also in the US. So we invest over Europe. We have teams in Hamburg to invest in the German-speaking market. We have teams in the Nordics based in Stockholm. So we see it actually in all those regions. But still, if you're an amazing startup, amazing team, like growing like a rocket ship, have amazing unit economics, those companies can still, to a certain extent, dictate the terms, not at the crazy valuation of 50 or 100 times ARR, revenue levels or multiples, but still very decent valuations.
I think that's really interesting also to note that it'll be a bit more bifurcated. So those that have really strong unit economics and strong business dynamics, they will still have this maybe similar level or still have a decent amount of control over the terms, but maybe it'll be a bit more impactful for some of those companies that are not as strong.
Exactly, and also what I think what will happen, so venture capital funds will have a harder time raising money, because let's say pension funds and so on, they can decide, hey, do I want to go for bonds where I get a very interesting interest now because those are increasing, or will I go for the risky venture capital asset class where I just don't know, like some of the funds will perform in the future less good because they invested at the high multiples over the last year. So the venture capital class will just attract less funding. So what will happen? That VCs will think twice before investing in you. They think, oh, I also have my portfolio to think about, maybe to do a bridge round. So they will think twice before doing new investments, and also they will think carefully how risky it is. So the more risky it is, the less chances they will do this investment. So if you have a long pathway before profitability, so if you make very deep losses for many years ahead, you will be less likely to receive funding. If you're a company that's in deep tech, where you have to wait a lot of years before seeing actual revenue, those will also have probably a harder time attracting, unfortunately, funding. So I think for certain companies out there, it will be harder to raise. And for the, let's say, the tier one companies, I think a lot of investors will just go there because they deem it as less risky also.
I think maybe one of the positive lessons is, having a little bit more discipline about some of your metrics that you're tracking and trying to optimize for those metrics will put you in a better position to try to secure that funding. And we heard a little bit earlier from a deep tech startup source. One of his big takeaways was making sure that you're doing that research to find that investor that really aligns with your vision and your purpose. So I think that that's also extra important to do that research phase. But I love the practicalities and your advice and how you view the market. So I also want to use that in thinking about how can companies, like what can they do to weather this, this market and the tightening market? Are there any tips that you can suggest?
Oh yeah, for sure. I mean, like venture capital has been around for a long time, many decades in the US, in Europe, and throughout all those phases, there were cycles with ups and downs, with booms and busts. We had the internet bubble, and some of the most valuable companies were created in the internet bubble or in a crisis of 2008. And what a lot of those companies had in common, they were just raising like all they could raise to weather those storms. So be more flexible, I think, on your terms, like lower the valuation, get the money in, because it will be way more valuable and strategic for your company just to survive. And also have a leg up compared to your competitor. So I think that's one thing. Raise lower amounts. That's also one thing. Look at your organization, where you can optimize, where you can cut, unfortunately, in your organization just to become more profitable so your metrics will be better towards investors in the future. Look at all the countries where you're active in and like zoom in where you're really profitable and where not. Maybe in few countries where you started, your unit economics will be probably less good compared to your home markets or countries where you're already active in a few years. Those kind of things you should look at in order maybe to extend your one way from, let's say, half a year or a year to hopefully 24 months. I know maybe it's wishful thinking for a lot of startups having this type of runways, but be creative, try to become profitable if that's a possibility, and go for it. It's hard, it's tough, but we see a lot of companies make it possible.
Maybe in picking up on that, for better or for worse, I think that the Dutch startups by nature, our founders are maybe a little bit better equipped and conditioned to focus on profitability and unit economics versus some of their counterparts, many of their counterparts in the States, for instance. Yeah. You've been with Undied for 10 years now. You've obviously been through the COVID period. Do you have any specific examples on like some of your portfolio companies, named or not, that have implemented some really impactful ways to extend their runway?
Oh, for sure. I mean, I think the more creative entrepreneurs are, the better they can weather any storm. So to be creative, you have to obviously have an intelligent team, a focused team, and say to a lot of things no, and focus on the really things where you can really add value to anything. So to give you a few concrete examples, in Corona days, we had 3 portfolio companies who were basically in the wrong corner of Corona. 2 in the travel business and 1 in the fitness industry. Obviously, we had other companies that performed really well in Corona days, but let's focus on those 3. So one was called Tour Radar. They had a double whammy. So they were offering social group travel to far destinations. So that's a big no in Corona days. So what they did, they went into hibernation mode. So they cut down their sales, they cut down their customer service because there was nobody to sell into service, right? Nobody can book those things. But they focused on their R&D department to keep on innovating, become more efficient as an organization, optimize it more. And now that Corona is over for the travel industry, they're performing insanely good. They're profitable. Their margins are much better, and investors are standing in the line. So that's one great one. Another one where we invested in, it was all before Corona, obviously, that we did those deals. So they raised 4 months before Corona, had 40 million together with some other investors. And then Corona hit. We're kind of fucked there, right? and it was in the B2B travel space. And we didn't know how to deploy the money. They had some kind of acquisition strategy to acquire other companies, but we kind of accelerated that initiatives because we were the company in Germany that had all the money, and all the legacy or new kids on the block didn't have money and were like needed cash. So we bought in 12 months' time 7 companies on the cheap. We created the biggest book of clients for the B2B travel industry in Germany, and also quite one company in Sweden. And then we became a great European company for Unicorn from the US who acquired this company. So it was a great result for all parties involved. And the final company I'd like to mention is Virtua Gym. So they're like a scale-up SaaS business in the fitness industry. So we made worst case scenario already in February, March, let's say 2020. Clients will go away. 50% of clients will go away. No new sales, because who in the fitness industry as a gym owner wants this software? So what they did, they stopped their whole R&D department. Stop what you're doing. Make now Corona features. Make the best Corona-proof features and be the first in the market to offer those. So they did that, and without any marketing and sales spent, a lot of fitness entrepreneurs want to work with them for hybrid training, offline, like online training from your home or from your work, or having capacity features for your gym. So without any sales or marketing, they're performing as good as possible, but just focusing more on R&D. And also there we optimize the organization. Hey, how can we become better? And like which countries to focus where we have good unit economics. And now they're just profitable and growing and growing. So we're happy that sometimes those tough things can happen, but a lot of the times those companies come out stronger. So these are a few inspirational examples of some of our challenging, at the time, portfolio companies are now doing really well.
I think that's a really great takeaway also, is that there's a lot of opportunities that are presented in times of disruption. So having that mindset to be adaptable, be creative, and test and iterate and see what ends up sticking. And then probably the Virtua Gym, I'm guessing they still use a lot of that virtual, have a lot of those virtual sales, because I still don't go to a gym. Not that I work out that much, but still, I prefer being in the comfort of my own home. So a nice new secondary business model for them, I can imagine.
Yeah, for sure, for sure. It's doing really well. Yeah.
Well, great. I mean, this is has been super informative and a lot of practical takeaways, I think, for the folks in the audience. So thank you so much, Ilan, for spending your time with us today.
My pleasure.
Thank you.